Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Hello, and welcome to LiveSquawk's Market Talk on Wednesday, the 18th of March, 2026. On this episode, we'll be previewing the March FOMC rate decision due in a few hours. At 3 precise, we'll get the announcement at 1400 EST, 1800 GMT, followed 30 minutes later by a press conference hosted by outgoing Fed Chairman Jerome Powell. To help me understand and make sense of all this, I'm joined by some very knowledgeable and respected guests. Firstly, a warm welcome to regular contributor Joseph Choi, author of popular market blog, The Curve Advisor. And secondly, we're joined by a first-time contributor, someone we're very lucky to have, David Rosenberg. David is the founder of and president of Rosenberg Research and Associates, Inc., an economic consulting firm he's established in January of 2020 after an illustrious 3-decade career on Wall Street and Bay Street as an economist and market strategist. A warm welcome to you both.
Thanks for having us on.
Awesome. Before we continue then, and the niceties out the way, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. LiveSquawk is not licensed financial advisor, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. Right, that out of the way then, just a quick preview. There's a preview up on the LiveSquawk website that's titled Fed Faces Energy-Driven Inflation Dilemma as Market Reprice Rate Path. With the war in Iran in its third week and oil prices roughly 30% higher than a month ago, US Fed Reserve rate setters are gathering to decide on monetary policy. It's widely expected that amid heightened uncertainty, the FOMC will vote to hold interest rates within the 3.5–3.75% target range. For many analysts, the concerns around energy prices is less about how high and more about how long. Just a note here from Barclays, they say the issue of persistence will be key for the central bank reaction. The textbook policy prescription is for central banks to look through temporary supply shocks. However, with inflation expectations still elevated and potentially less firmly anchored after years of above-target price growth, central banks may not have that luxury if high energy prices persist and feed through to consumer inflation. With that, I'd like to bring in David, first of all. David, just in terms of the decision itself, any views on the messaging that you think we're likely to see from Fed Chair Jerome Powell?
Well, I think that first and foremost, the easy call is that the Fed is going to stay on the sidelines. And you're quite right to ask about the messaging. And that's difficult to handicap because we'll get the official press statement right away. And then we'll get Powell going to the podium for the press conference. And quite often, he deviates from what's in the official press statement, and maybe now that he's increasingly becoming a lame duck, what he has to say at the podium becomes less important in terms of his own personal views. But my sense is that it's really going to be, much more of the same. No rate cut, no rate move, and I would say it's probably going to be a classic Harry Truman commentary on the two-handed economist. I think that he'll have to acknowledge that the labor market is no longer resilient because at the margin it has deteriorated. And we had not just sharp downward revisions to last year in terms of payrolls, but last week we got the JOLTS data. And when you look at hirings and job openings, they were marked down a lot. So even the overall backdrop of the labor market was far weaker in 2025. The levels are coming off of are much more depressed. I think that has to be acknowledged because the Fed does have a dual mandate. So I think that they'll probably water down their ongoing commentary on how resilient the economy is, and that'll be balanced by upside risk to inflation. So, it's like last year, Powell made that brilliant quote about what does a central banker do, when you're in the room with the lights off and it's completely dark. And he said you just stand still so you don't trip over a chair. And that was over the tariff file. And now we've replaced the tariff file, although that hasn't obviously gone away completely, with what's happening with the war in Iran and the implications for inflation over the next few months. So we're back to the same sort of balancing act that the Fed was doing between, say, growth and inflation because of the tariffs, and now we've replaced that with the war in Iran. So I think that for the next several months, in any event, they're probably still going to be on hold. The question is, once the war ends, and it will end, what the interest rate outlook will be at that point. I think the market got ahead of itself and pricing out virtually the entire year. December is a long time away. But I think for the here and now, it's going to be what you see is what you get, which is the Fed on hold. And I would have to say probably an even-handed um, communicate to the markets. I do not believe for a second that they're going to validate any residual expectation that they're going to be hiking interest rates, notwithstanding how hawkish some of the FOMC members are.
Sure.
But I think that it's going to be just steady as she goes, and they're going to be in that dark room standing still for at least the next several months.
Good points. Good points. Joe, do you concur with that? Is there anything else you want to? Do you see anything different in terms of the reaction function of the Fed?
I agree with everything David had to say. I think uh, some of the things I'll be looking for at the meeting as a trader is just the dispersion of the dots for 2026 and 2027. Most economists think they'll still have the one ease for the rest of this year. However, I do want to see if there are any dots playing for suggesting a hike, or if a bunch of the dots move lower, implying some tail risks to the growth side of the mandate. And then the other thing I'm curious about is, for many meetings now, economists have expected the neutral rate to increase. I'm actually curious if the Fed thinks the longer end neutral rate has increased or decreased in light of the tensions between the inflation mandate and the employment mandate. And then I guess in terms of Powell's press conference, there are a few things I am looking at, even though he is uh, he is, what is that word? Yeah, he is a lame duck, but I think because the Warsh nominations look like they're going to get pushed back, he is going to be with us probably longer than the markets expect. And so I think, what he has to say still has some validity in terms of representing what the body of the FOMC are thinking. And so the last time we heard Powell talk, he seemed somewhat confident that inflation would be transitory. So now that this war looks like it's going to last longer, I'm wondering if what their perceptions about reverberations through supply chains and are going to be. And so I want to just try and get a sense of the Fed's new reaction function because of the war. So the Fed thinks oil inflation is going to be transitory, and they usually don't make one big deal of 1 month of data like last month's ugly employment report. But I do want to get a sense as to what is it going to take for them to hike, what is it going to take for them to ease, and just try and get. So he's not going to say specifically, but I do want to try and get a sense as to what the body is thinking and what their lean is going into future meetings.
You use that T word twice there, Jay. The transitory thing. I was going to use the P word,
Yes.
persistence, inflation persistence. Now, I mean, we're going to come on. We're going to come into the growth element of this and at the effect on growth. I mean, is everyone seems to have taken it for granted that we're looking at inflation popping back up again. We saw the persistence in the CPI report and PCE reports that we've seen of late, services particularly, and we've just had PPI data out, so factory gate price data that's shown to be elevated as well. David, if we want to, I mean, we'll look at the inflation side as well, but on the growth side, something you've written recently that says the economy was on a soft terrain before the war started. You referenced the Q4 downward revision as well. Do you see us moving towards a recessionary path for the US, depending on the length of the war? I know it's a big question, but
Yeah, well, that is making the call on the economy really hinges on your assumptions. If this war drags on for months and not weeks, and it keeps not just energy prices but also food, the things you can't really substitute away from, that is not just going to drain all the fiscal policy stimulus from the one big beautiful bill, but that could actually be a very serious constraint on consumer spending. So the longer that the war lasts, the longer that we have oil prices where they are, I don't think you got to go to $120 a barrel. I think that if they don't come down, considering we were close to $60 a barrel, before this war, that is going to have a lingering impact on consumer spending and confidence. So yes, I think that, and then there's obviously the knock-on impacts on exports, which has a very big multiplier impact in the economy from the fact that it won't just be a U.S. recession; it'll be a global recession. So I think we have to factor that in. The major point that I would make is that uh, one of the reasons why we had that, I guess you would say, non-transitory inflation bulge 2021 to 2023 is that we had, we didn't have this, I mean, what do you want to call it? Tax for tips and the SALT deductions and income tax refunds. It's really, in the overall scheme of things, not that big a deal compared to the $2 trillion of pandemic stimulus checks that were handed out to anybody who had a pulse, just as the pandemic was ending. So, we were handing out all this fiscal stimulus, and then we have Pfizer Monday. And the next thing you know, we have wasn't just supply chains anymore. It was radical fiscal stimulus creating tremendous excess demand. Well, that's not happening this time around. There's no stimulus checks. So we're going to get a demand response. And so I think that recession risks right now, right as it stands right now, third weekend of the war, I wouldn't say we're heading into recession. But if this is still around, I'd say a month from now, and there's been no relief on especially food and fuels, those recession risks, I think, will emerge as a base case scenario. I'll only say, going back to the Fed, it was very important for them, obviously, as inflation expectations. That was the one really incredible thing about the Trump tariffs is that inflation expectations never really became unhinged. And the Fed may say, well, that's why we kept rates deliberately in a restraint mode to lean against that possibility. But we have a much weaker labor market on our hands right now. And from my perspective, this inflation run up that we're going to have and headline inflation, and there's no doubt the next few months are going to be some ugly numbers. But I think that this inflation is going to hit the wall in the labor market and end up just leading to a contraction in real incomes and real spending. And of course, that's predicated on just how long this lasts. So it's going to be important for the Fed, beyond just inflation expectations, is what happens to core inflation. Will this be a relative shift in pricing or an absolute shift in pricing? The problem is that when you have the labor market deteriorating, and I say that the price shock hits the wall in the labor market, what it means is that you get the statistical inflation in food and energy, but then inflation in the other, call it 80% of the CPI or PC deflator,
Right.
ends up decelerating sharply. So the core is going to be the key. I want to remind everybody that you want to use a template. Go back to Gulf War One, which started with Operation Desert Shield in August of 1990,
Mm.
morphed into Desert Storm, which terminated in February of 1991. So that entire conflict, that lasted, that lasted, more than 6 months.
Yeah.
And the actual war, the war part of it, which was Operation Desert Storm, that lasted 6 weeks. And so we got a recession out of that.
Mm.
But at the time, when you go look at the FOMC transcripts, you could see that Greenspan did not think we were heading into recession, but he cut rates anyways. He cut rates. He didn't raise them. He didn't stay on the sidelines. He cut rates because as the data was coming in, it was evident that core inflation was actually going down. So the
Okay.
people had the view that this was a relative price shock that was going to cause almost like a de facto tax increase for the rest of the economy beyond food and fuels. So headline inflation went up because of food and energy, especially energy, but
Mhm.
core inflation came down. And that opened the door for the Fed to cut rates. So if you had that view that the Fed back 1991, I guess I'm old enough to remember that, you had the view that, oh, the Fed's got to be on hold indefinitely, that they're going to have to raise rates because of headline inflation. No, that's not what happened. And
Okay.
I think that's a template we can actually go back to, because I do think when push comes to shove, the balance of risk is that the Fed will end up cutting rates more in the second half of the year than what's priced in right now.
But what I would push back a bit, and Joe, please come in on this, is that the core measure that we're seeing has been stubborn and has really fueled what some people, some of the hawks are looking at the moment, and it's kept them stubborn at the moment. So do you not think there's slight difference in that between what we saw back in the early 90s and where we're seeing now, where the services side of the inflation picture is just that little bit more stubborn and sticky than maybe we saw back then, because there was different dynamics at play. The infrastructure was different, and we were looking at different load bears. Uh, Please come back on that if you want, David, or Joe. Do you agree with the comments there by David?
Oh yeah, yeah, I agree with most of what David had to say. I mean, right now, Kalshi and Poly Market have the odds of a recession at a little over 30%. So I'm not sure if that's this, quote unquote standard definition of a recession where it's 2 quarters of negative GDP, because I think with some of the CapEx spending we're getting, that might be hard to get. But I do think there is downside risk to labor. So right now, in terms of the trading, it's very difficult. It's a very difficult environment because just like David can't really make any strong predictions because we don't know how long this war will last. It's the same thing, I guess, from on the trading side. Like, I don't know how long the war is going to last. I don't know. I mean, and depending on what happens, we may need to ease or hike. And then, so it's like a very uncertain environment right now. And unfortunately, all we can really do is see how things materialize in terms of the progress of this war. I think the administration is kind of implying it's only going to last a couple of weeks, but this could, there's a tale that it could last like the rest of the year and through next year if they can't come to some sort of resolution. So, I mean, so I think Trump wants the taco, chicken out. But it seems unlikely he can do that unless he can claim some material win. So I guess just in the short term, some turning points I'm looking at are us getting our hands on the nuclear materials, or us playing whack-a-mole and getting a leader that we actually like. Uh, but I think the thing that I'm focusing on is how successful these escorts going to be, or assuming he even goes through with it in a couple of
Do you think
weeks.
that's feasible? I mean, do you think? I mean, we can. It's a whole different subject. But I mean, the feasibility of trying to escort ships through the Strait of Hormuz,
I,
if
I,
they have that
I,
in mind. You know,
I mean, unless we have some sort of efficient technology to handle the drones, it just seems like, I mean, they can launch a drone from anywhere in the mountains. I mean, they're just a ton uh, of places where they can launch a kind of aerial or water drone, or or do anything with boats, and there's so many different ways to attack that narrow point that it's not really clear to me how what tools we have. So that's why I said it'll be really interesting to see how that goes, because I think depending on how that goes, we could see an earlier end, or we could see a much more protracted a much
mm,
more
okay.
protracted war.
I mean, you make a point in one of your blogs. It says it seems to me that everyone is looking at the Iran war as a reaction to the latest news, and not as a medium-term game where differing parties have various objectives and manoeuvres available to them. Um, like you say, there are different. President Trump could claim victory now if he wanted to, if he really wanted to, because he, according to intelligence and his claims, they've taken out the majority of the navy. They've taken out. They own the skies. You know, there is a narrative there that he can push if he really wants to. And I guess because no one really knows what the end goal is from the US Israeli, well, I can guess from the Israeli side, but from the US side, it's like you say, this could drag on. I mean, today, 11 Revolutionary Guards has issued evacuation warnings for several energy facilities across the Gulf, according to the state media, and says Iran says some Gulf energy sites are now legitimate targets. So, I mean, even if this war in itself is over within the next few weeks, the infrastructure that brings the oil out the ground and stores the oil in the area before we even get to the Strait of Hormuz and the pockets of Houthis and whoever who could attack the region is still prevalent. So, David, like you say, I mean, you reckon this could be over in what, a month, 6 weeks, but potentially there are tailwinds to this as well that could mean that price pressure that we're seeing at the moment, um, and what it does to global growth lasts a lot longer. The effects last a lot longer, and therefore, as you rightly said, the central banks there are probably looking at the game from a more accommodative approach. Would that be a reasonable summation?
Well, I want to go back to a question you asked me about 10 minutes ago, which was
Yeah,
about
yeah,
what was holding up the service side. But we know that there's been actually a very mild tariff impact so far in terms
mm,
of underlying goods price inflation. It's been, I mean, it has hooked up fractionally, but not what most people had thought. The
right,
service side uh, is been airline fares and accommodations like hotels, recreational services. So the areas of the service sector inflation is very consistent with what you're seeing with the economy and the drop in the savings rate since last spring, which has been epic. I mean, almost half the growth in the economy has come from just the decline in the savings rate, which
well,
is principally because high-end consumers have been spending their equity wealth gains, the fabled wealth effect on spending for the top 10%. And that's reflected in the service sector inflation that we've been seeing. And that was always going to last as long as the stock market was making new highs. So that source of demand pressure on cyclical services that are really aimed towards the high end, that did show up in the CPI data. I mean, the stock market's not making new highs anymore. So I'm not expecting that you're going to be seeing cyclical services being an inflation problem for the next several months or quarters. Now that the stock market has peaked out, I think peaked out for the cycle. Let's put that aside and then talk about the elephant in the room, which is the shelter components. Owner's equivalent rent and residential rents together, they're like 30% of the CPI. They're almost 40% of the core.
Mm.
And we're starting to finally see, with a long lag, a break in that series, because we know in real time rents have been deflating for the past 18 months.
Okay.
That is going to be a dominant force. That's going to be a dominant force. So that's even bigger than food and energy
Right.
when you look at the weightings. So let's not ignore that in your inflation assumptions.
Okay. Fair.
And the other point I'm going to make is this. In the last big shock that we had, which was the pandemic, the Fed accommodated the inflation. The Fed was consumed with deflation fear in the winter and spring of 2020. And they did dramatic quantitative easing, unprecedented in its breadth and in its scope. And it accommodated that, turned out to be an inflation shock that the Fed accommodated. The
Mm.
Fed is not accommodating this shock. They're not cutting interest rates, at least not yet. And I admit that they'll probably wait till the dust settles, whatever that is. I'm not going to come on your call and pretend that I'm a military strategist. What I am going to say is that if we're willing to take a bird's eye view of inflation and get away
Right.
from the statistics, which are massaged by government statisticians, there is no monetary inflation in the economy. That is over. We have basically M2 growth running roughly 4% at a time when money velocity is no longer going up. Money velocity has stopped going up last summer. So you have stable money velocity, 4% money growth, and on the other side of the quantity theory of money, or the Fisherian identity, is real growth and inflation. We have 4% M2 and money velocity on one side of the ledger. You have, call it, roughly 2% growth on the other side of the ledger. And what falls out of that is inflation at 2% of the Fed's target. So I'm not going to sit here and say I'm going to focus just on the BLS statistics, okay? Because there's different inflation measures, right?
Sure.
You talked about PPI, talk about CPI, talk about the PC deflator, talk about the GDP deflator. There's more than one inflation statistic.
Mhm.
But there is only one quantity theory of money. There is no monetary inflation here. The Fed, by standing pat and keeping rates deliberately above their neutral level, however you want to define neutral, they readily admit that they've been keeping policy restrained for some time. They're not accommodating this shock. They're not accommodating it, which means that you're going to get, it's a relative price shift. Now, it means the headline goes up near term. That is statistical noise. And then core inflation is ultimately going to come down. I think it'll come down to levels that will be lower than they would have been without the war. So that's where I fall out of the situation. And by the way, the one thing we didn't mention is the other shock that's taking place. If it wasn't for the war, the front page news would be these escalating problems we're seeing in the private debt and private equity space.
Yes.
Which was that alone, the boom in credit there for startup companies that could not get financing from the banks. That was adding, in the past 3 years, that was adding, the boom in private debt, private equity, was adding a half point per year to GDP growth. Well, that's just been undercut. So I think people aren't talking about the looming credit crunch. People are talking about the fact, as they say, oh, well, look how well the stock market's hung in. I mean, as of the close of last Friday, the financials were down 12%.
Yeah.
They're telling you something. And this is exactly what happened, actually. There's a lot of similarities to what I talked about 1990 and 1991. It wasn't the clerics in Iran, but it was Saddam Hussein. It was not a war that was over in a few weeks, admittedly. We had a different Fed, but a Fed that recognized the difference between an absolute shift in prices and a relative shift in prices. And Greenspan was gingerly cutting interest rates, but in the end, not enough. All the while, we had a credit problem on our hands. I go back to the summer, the summer fall of 1990, the winter of 1991, and the Iraq War was all we were talking about. When we should have actually been talking about the bubble bursting in commercial real estate
Mm.
and the end of the LBO craze, because that bubble burst. So we had a credit bubble that was cresting and about to burst. This was not the housing market in 2007, 2008. This was the other credit bubble in 1990 and 91. And that ultimately we had to create Resolution Trust Corporation to clean up that mess. We had a war. We had headline inflation for a while. Core inflation did not rise. The Fed was slow to cut rates, although they did cut rates. And then we had a recession uh, starting in the summer of 1990
Mm.
that nobody saw coming. The next thing you know, Greenspan's talking about pushing on a string because of the credit crunch. He's talking about 200-mile-an-hour headwinds and a jobless recovery. And if you told anybody back in 1990, when the funds rate was like 7%, that we were going to bottom at 3, you'd have been carried out in a gurney. So the name of the game here is not to be myopic,
Yeah.
not to look as far as the tip of our nose, and not to pretend we're military strategists.
Yeah.
This to me, and especially with the Fed not accommodating this shock, what this is going to be, if you put your big picture hat on, not your trading hat, but your investing hat,
Mm.
this is a gigantic, I would say, deflationary tax shock on the economy. And it's coming at a time when a very significant credit bubble is in the process of bursting. And you can see that. You can see that in the corporate default rates, which are hooking up. And you can
Yeah.
see it in the redemption wave and the gating in a part of the capital structure that became out of the blue $2 trillion of outstanding uh, credit.
Mm.
So, yeah, I think that we have multiple shocks going on right now. Probably 4 of them. The other one is the AI shock on hiring activity, which is very evident to me is on inflationary.
Yeah.
So I come out of this with a slightly. I don't think there's a snowball's chance in hell the Fed's going to be hiking interest rates. I think that would be a crazy thing to do.
It's
Will
very
they be on
categorical.
hold? Yeah, they'll be on hold for a time. But like I said, I think that if you put your investment hat on, rates coming out of this war, counterintuitively,
Mm.
will be lower. And you'll say, well, but we're going to bottom out at $80 on oil or 90
Mm.
as opposed to 60. We could bottom out at 90. But once you bottom out at 90, it's at a higher level, but it's not adding to inflation anymore because inflation is a rate of change concept. It's not a
Sure.
level concept.
Can I ask a quick question, just to cut across you? Pre the war, then, would you have been on Myron's side, and knowing all you know and what you're warning of in terms of the private capital, would you have said we need to be a bit more aggressive with the rate cutting side?
I was never in his camp because I mean he was his you know the extent of because firstly the Fed was not that far above neutral,
Right.
and I think he was playing with fire. Okay. Those 50, 75 basis point rate cuts that he was calling for initially, you do that when the bad stuff really hits the fan.
Right.
So I, um, I was never a big fan of his view that the Fed had to be that aggressive.
Okay.
Do I think that the Fed should be cutting rates at the margin? I think they should have got down to neutral, but we're splitting hairs because maybe that's just 25 or 50 basis points away. Then the
Yeah.
question is, what is the inducement to go below neutral? And I think that we're going to be seeing a lot of that in the second half of the year. I'm not a military strategist, but if this were to drag on in the next year, um, I mean that is just a horrible situation.
Mm.
Um, I don't
Like you
really
say,
see.
globally as well, not.
I don't really see that happening because again, I think everybody's just extrapolating and they're very impatient. And now everybody's saying that Trump never had a plan, doesn't have a plan. I'm pretty sure they've been planning this since last June's bombing of Fordo. They've been planning this for a long time, and so to extrapolate day after day, week after week, is probably a big mistake. And we haven't seen the full response of what the White House is going to do
Mm.
to get oil prices back down. People think that they can't shoot down those drones. Well, I think they're sending over troops to that part of the world to deal with that situation. You know, whether they overtake all of Cargo Island, and that's I think what they're going to do,
Which
or
is
they
one of the suggestions that we're seeing in the hearing.
or they take out a slice. I mean, they're not going to invade Iraq. That's not going to happen. But there's things that they could do to get on the boots on the ground
Mm.
and get munitions on the ground that can definitely shoot down those drones.
Okay.
But because we just live day by day and hour by hour, the latest headline news, people think that's not going to happen. I've
Listen,
been with you on that. Although I said I'm not a military strategist, I'm an interested observer. But I do know that the responses will change.
okay, awesome. Joe, from the trading, I want to bring it round because we're coming to the end of the episode now. Joe, I want to bring it round to today's meeting again, then, and the press conference. And as David alluded to earlier, Powell isn't likely to be committed, pre-commit one way or the other. I've got a note here from JP Morgan that says they expect obviously no rate change, a very close call on whether the median dot shows 0 or 1 cut, and communication emphasizing uncertainty, patience, and stable expectations. As a trader, how do you address today's FOMC and the fallout? And I know you don't trade the immediacy of it. You look at things from a wider stance. What will you do? How will you prep for today and for the backwash tomorrow and to the end of the week?
Oh, well, so note is that the options market is actually pricing in a decent sized tail that the next move could be a hike. So it's not, a full meeting, but it's probably a tail worth about a half a meeting by year end. And so I don't think the hike scenario can be discarded because, again, they do have a tension on these two mandates. Um, and then in terms of listening to what I basically have nothing in the next 18 months because there's just no, I mean, just like as a
Wow.
trader,
Okay.
I have no visibility. I think David could probably also say as an economist, I mean, there's very little visibility in terms of, you know, like what the Fed's going to be doing 6 months from now. So, um, yeah, so basically all I can really do is just try to get a better sense of of Powell's reaction functions. And even though he is a lame duck, a lot of the times he will speak for, the Fed as a whole. Now, I mean, my base case, like everybody else's, is that the Fed's not going to be doing anything anytime soon because the farther away both mandates are, the less likely the Fed is going to act because you need the worst mandate to move even further to get the Fed to move. And so, but I do want to know what their reaction function is going to be.
Okay. The pace of reserve management purchases, do you think they'll touch just briefly? Do you think they'll touch on that, or like you say, they're no pre-commitment? They want to leave that as is at the moment and just see how this plays out over next until the next meeting. Joe?
Oh, yeah, I don't really have a strong view on that. I think the Fed put that in place just to handle the volatile fixings that we had been getting. And
Right.
I think the presumption was that after tax season that they won't need to be as aggressive. So I assume they'll lighten up on it at some point. But I would be surprised if they said anything about it now since we're still a month away from tax season.
Okay, awesome. David, any brief views on the pace of reserve management purchases, or you of a similar thinking?
I don't think that there's going to be anything there in terms of the reserve management part of it. It's really all about what we've been talking about, which is the Fed's reaction function and whether or not even today, do they validate the markets basically taking out almost all of this year's rate cuts? Or do they even signal a hike? I'm not expecting that, but you can't rule anything out. To me, it's just like it always is. It's just about their guidance on interest rates. Full stop.
Excellent. Okay. On that note, then, just to quickly remind everyone, then today's rate decision is going to be at 1400 EST, 1800 GMT. With a press conference 30 minutes later, where we'll hear from Fed Chair Powell himself. I'd like to thank my two guests, Joseph Choi of the Curve Advisor. Thank you, Joseph, for your participation today.
Hey, thanks for having me on.
No problem. And David Rosenberg. David, listen, it's been an absolute pleasure having you on and listening to your insights. They've been very valuable. David, the founder and president of Rosenberg Research and Associates, an economic consulting firm. David, thank you very much for participating and for coming on today. Very much appreciated.
100% my pleasure. Thanks for having me on.
No, it's our pleasure. Trust me. Yes, anyone who missed the start of this episode can go back on the socials or listen to the one of the podcast platforms out there, so Apple iTunes or Spotify, to pick this up again. Anyone wants to listen in live to the rate decision itself, just go to LiveSquawk.com, take out a trial and listen live to us announce the rate decision, and we'll give you the subsequent comments there from the press conference 30 minutes later. But thank you all for listening, and we'll see you again tomorrow when we cover the ECP and the Bank of England previews in a show as well. So thank you, and see you soon. Thanks for tuning into the LiveSquawk podcast. Your edge in the market starts here. Subscribe now.